I understand that taking 75 basis points off the table is a big deal, but a 900-point rally is huge. Take us through what your thoughts were after hearing those comments.
Well, I mean, I think the Fed chair did exactly what economists were expecting. That economists realize that there are risks to growth in the United States. They realize that inflation has peaked. And the Fed chair was reflecting that, I think, in a relatively measured set of comments and an outlining of an as-expected passive quantitative policy tightening and the 50 basis point increase and nothing too alarmist. What we have, of course, is this age-old problem that equity markets don't listen to economists. And equity markets should listen to economists, because if they'd listened to us, they wouldn't have had the sell-off in advance, and the market would have taken this far more placidly. But what markets have had, of course, is just confirmation of the economic central case coming through. And because markets had overreacted and worked themselves up into a frenzy beforehand, we've had this reaction subsequently.
All right, Paul, I'm laughing because in many ways I kind of understand what you're saying about the volatility. Let's say I am willing to listen to economists like yourself. So take us through the reasons why you made that comment. Why is it that inflation has peaked? What are you already seeing? And if it has peaked, what can we expect to see data-wise that would justify that in the coming months?
So essentially, there are three reasons why inflation has peaked. The first is that prices are already coming down for certain products. Either the inflation rate is lower, or in some cases, the inflation rates turn negative. And this is the areas where we were seeing the very strong inflation last year, things like used cars or televisions, that were really being pushed up by this extraordinary demand. Well, that extraordinary demand isn't there anymore. The stockpile of savings has been spent. The consumer has been normalizing. They've been switching back to spending on services. And as the demand has moderated, the price increases have moderated. And we've already seen that. And this was always why inflation was transitory. Second reason is base effects. You've got to remember that in March, we in the United States were comparing prices in a normal economy in March 2022 with prices in a lockdown economy in March 2021. Of course, there's going to be a big change if you're comparing lockdown to normal. But as we go through the next couple of months, we're going to start comparing a normal economy in 2022 with a reopening economy in 21, and then a normal economy in 22 with a normal economy in 21. And that means that the change in prices is going to come down. And finally, although we're going to get a sticker shock on the labor cost numbers later today, which is just a statistical quirk, we're not actually seeing a wage cost price spiral emerging. There's just no evidence of this. And all of this is suggesting that the moderation of inflation is coming through. And what we're going to be looking for is, in the detail of the data, continuing to see either disinflation or, in some cases, outright deflation of product prices as demand moderates. And, of course, looking for the base effects, that year-on-year comparison. Those are going to be the two immediate signals of the peak. And then later on this year, it's going to be ongoing moderation of productivity-adjusted wage costs.